Hello everyone, this is how I would invest if I started my Roth IRA or TFSA if you're in Canada from zero today. I prefer simplicity and I would only use my top 3 maximum 4 tickers for these 3 examples. Here's my pick if I was only ETF investor. I would invest in S&P 500, Nasdaq 100 and have some exposure to income ETF. But I've also got a stocks-only version, and my favorite of the 3, a strategy that I successfully used myself that blends both. Stick around, because by the end of this video, you'll know exactly which of the 3 I'd put my own money in. Roth IRA or TFSA are one of the best tools you have for growth, because the gains inside these accounts can grow completely tax-free. That means the strategy you use inside them should be built for one thing: long-term growth. So everything I'm about to show you assumes you have time on your lap, meaning years, ideally a decade or more, before you need this money. So let's start with portfolio 1, ETF only. If I wanted something simple, something that I could set and have very low maintenance with, I'd go with ETFs only. Here's the split. I would put 30% in QQQM. This tracks the Nasdaq 100, so you're getting exposure to the largest tech and growth companies in the world in one single fund. I would put 40% in VOO. This tracks the S&P 500, so you're adding broad exposure on the 500 largest US companies across every sector, which balances out tech-heavy QQQM. And I would put 30% in QQQI. This is a Nasdaq 100 income-focused ETF. I keep this so that it adds a bit of yield on top of my growth for reinvestment. Why this mix? QQQM gives you aggressive growth, VOO gives you diversification and stability, and QQQI adds a small income kicker. It's basically one fund for growth, one for balance, and one for a bit of cash flow, but all of them contribute to growth. Second portfolio, stocks only. If I wanted to be more hands-on and pick individual companies, here the stocks only version. We'll keep it quite simple. I picked the best of the best in my view. 40% in Google, dominant business across search, advertising, cloud, and now AI with a strong balance sheet. 40% in Nvidia, the company at the center of the AI and chip boom, powering a huge chunk of the infrastructure behind AI as of right now. And I would put 20% in Micron, memory chip maker that benefits from the same AI and data center demand, but often overlooked compared to other Mag 7 stocks. This portfolio is more concentrated and more volatile than the ETF version. You are betting heavily on tech and AI specifically. High risk but potentially high reward if that trend keeps playing out. And the third portfolio, my favorite, I call it Barbell Strategy. This is the one I personally used myself. And you combine a broad diversified core with a few concentrated high conviction bets on each end. I would put 40% in VOO, broad S&P 500 exposure as the foundation, 20% in Nvidia, high conviction AI bet, 20% in Google, well-diversified tech giant, and 20% in AVGO or Broadcom, another AI and semiconductor infrastructure play, but with a more specific business than just GPU makers. The idea here is to let the ETF do the entire heavy lifting for diversification and use the individual stocks to tilt the portfolio towards higher and more exponential growth. But if you are someone who doesn't want to think about individual stocks at all, the ETF-only portfolio is a completely way to go. It's stress-free and hands-off. One more time, this only works if you have time. If you need this money in the next few years, this is not the approach to take. I would put my money into some short-term treasuries or cash accounts. Let me know in the comments which one of these three you would use: ETF only, stocks only, or the barbell. And if you want me to break down how I adjust this as I get closer to the retirement, follow for future episodes. See you at the next one.